The truth, your S&P 500 ETF is riskier than you realize. Something of a clickbaity headline by Cress here, but he does point to a substantive issue with S&P 500 Index ETFs. Namely, because the index is market cap weighted, so is your ETF. And if you're in SPY, roughly 25% of your ETF's assets are now in 5 different stocks: Apple, Microsoft, Amazon, Facebook, and Google. So his solution to this is to diversify into value stocks, but that has its own issues. One is value stocks have underperformed for years, and another is if there is a market crash, your value stocks are going to be going down too. So another approach would be to hedge, and we'll look at doing that. But the first question is, how much should you hedge against? What kind of decline should you hedge against? And for that, I go back to a column from John Hussman back in 2008. He made an interesting point about avoiding intolerable losses. And what he came down to was hedging against a 20% decline kind of makes sense because although it's painful, you can recover from that with a 25% gain, and that kind of gain is not unusual coming out of a crash or a bear market. Even in a bear market rally, you might be able to see that. So if you want to look up this column by Hussman, this was October 20th, 2008. And now let's look at hedging SPY in a simple way. So what we'll do is we'll use the Portfolio on our iPhone app, and we'll enter in the symbol, which is SPY. And then we'll enter in a number of shares, and here I'll enter 100. And then we'll take John Hussman's suggestion, and we'll use a 20% decline threshold to hedge against. Find optimal hedge. And after a moment, we're presented with this optimal put option contract to hedge against a greater than 20% decline in SPY by March 19th. And as you can see, the cost here was $898, or 2.72% of position value. And that was calculated conservatively using the ask price of the puts, while in practice you can often buy and sell options at some price between the bid and ask. However, if your concern is primarily political risk relating to the election, what you can do here is consider using a shorter time to expiration. Now, before we do that, let's look. The cost as a percentage of position value was 2.72. Annualized, that came out to 5.51% of position value. Now, what if we just take the expiration date closest to after the election? That would be November 20th. And we tap that. And now we're presented with the optimal put option to protect against a greater than 20% decline in SPY by November 20th. And as you see here, the absolute cost is lower. It goes down to $166. The cost as a percentage of position value is lower too. It goes down to 0.5% of position value. But what's interesting is the annualized cost is lower too. In this case, it's 3% of position value if you annualize that cost. So this is something you may want to play around with. Try different expiration dates. If you can tolerate a larger decline than 20%, you could enter that, and that's going to lower your cost as well.